Hello and welcome to today's A-Team Group webinar on managing Libor transition. My name is Sarah Underwood. I'm an editor at A-Team Group and will moderate today's webinar. Our expert speakers today are Jacob Rank-Broadley, Head of Libor Transition at Refinitiv, Mathieu Cazadeval, IBOR Transition Director at Societe Generale, Calvin Zahn, Director and Head of the IBOR Transition Program Office at RBC Capital Markets, and Phil Lloyd, Head of Market Structure and Regulatory Customer Engagement at NatWest Markets. I'll ask them to introduce themselves in just a few minutes. Meantime, so that you can take the best part in the video, to the right of the video, you'll see a box for questions and polls. We'll be running 3 polls during the webinar today. So I'll let you know when the polls are coming up. Please do fill in the tick the boxes or whatever you need to do, and be interesting to gauge interest on the questions. There's also a panel there for you to ask questions to our experts today. So please do put them there, and I'll ask as many of the questions as I can as we go along. I won't wait till the end, so if you have questions as we go along, please post them then. Thank you very much indeed. And also you'll see on your screen some other A-Team Group resources in the additional options space towards the bottom of your screen. Today you can register for our RegTech Summit Virtual in June. You can download the latest regulatory data handbook, and that is quite a tome. You can download a very relevant white paper on how to leverage the Libor transition to improve your data management plans. So that's enough of me for the time being, and let me come to our speakers. Jacob, please introduce yourself.
Sarah, hi everyone. So I'm Jacob Rank-Broadley, Head of Libor Transition for Benchmarks and Indices at Refinitiv. I'm responsible for the introduction of new benchmarks such as Term SONIA and the US dollar IBOR cash fullbacks, which have been recently introduced by the ARC.
Lovely, thank you. Mathieu, coming to you, please introduce yourself.
Yeah, sure. Hi, how are you? Everybody, my name is Mathieu Cazadeval. I'm working for Societe Generale, and I will be driving the transition for the whole group into Libor. This is both retail, wholesale markets, asset management, and so on. And I've been a practitioner on the fixed income market for more than 15 years. Thank you.
Thank you. Calvin, please introduce yourself.
Hi, good morning, good afternoon, everyone. Thanks for having me to talk about my favorite topic, Libor transition. My name is Calvin Zahn, and I head up the Libor transition program here at Royal Bank of Canada, or RBC. We've been at this program for over 2.5 years now, and looking forward to this discussion today.
Lovely. Phil.
Hello, everyone. Welcome. Phil Lloyd. I'm the business lead at NatWest Markets for Libor transition, obviously partnering with our corporate bank, NatWest Group. I also co-chair the Sterling RFR Communications Working Group and sit on a number of the European RFR working groups. And NatWest obviously is quite a lead role in the Sterling RFR working group. So lots of insight, hopefully, to share with you guys today.
Thank you all very much indeed. So let's get on with the discussion, but first let's run an audience poll. You should be able to see the question to the right of your video, and it is: how much progress has your organization made on the transition from Libor to risk-free rates? While you answer the question, let me come to you, Jacob, to set the scene in terms of how you view progress financial institutions have made on the transition. How's it looking?
Thanks, Sarah. It's a bit of a mixed bag, really. I think it depends how you look at it. Really 2 lenses that we tend to look at it from. One of those is what market we're looking at, and the other one is what participants we're looking at. So on the market side, starting with GBP derivatives market, it's all looking pretty rosy. I think the latest stats show somewhere around 50% of the trades referencing SONIA rather than GBP Libor. Huge achievement, really positive. If you take out things like compression trades and technical trades, I suspect that number in terms of real trades actually looks much higher, probably north of 70%. So I think big achievement. Well done to everyone there. I think if you turn to the other currencies, we've still got a long way to go. The latest stats probably indicate we're around 5% of the way there for Saron, so Swiss franc market and the US dollar market. I think it's probably looking even more challenging when we come to Japanese yen. It's a tough time. Turning over, looking at the cash markets, It's a bit tougher. Stats aren't always easily available. Loan markets tend not to be particularly transparent. So I think there's probably a lot of work there. Also, we think about the type of participants involved. And then if we just switch over to the second lens, which I mentioned, which is market participants, I think you can break it down to three groups. And the banks, they're all over this, very well positioned. They've got good teams, very well prepared. They spent a lot of time thinking about it. There's still more implementation work to do, but I don't think there's any ambiguity around what people want to do. I think the buy side are catching up quickly. Asset owners have been a little bit behind the asset issuers. Don't think they've got any problems. I'm sure they'll be fine. Where I think kind of the big knowledge gap still exists in the corporates. A lot of them just haven't had the capability, the capacity in order to look at this. So I think there's probably a bit of a knowledge gap there, and they've got a long way to go.
Thank you. Calvin, what would you add to what Jacob said? What's your view of what it's looking like out there?
Yeah, I think Jacob summarized it well in terms of market developments. I would say that generally FIs have done a lot over the past 2 years, but there's still a lot to do for the remaining 250 days thereabouts. Past 2 years have been focused on product readiness, right? Scoping, sizing the problem. But now this year, we need to get on with it and move deep into that execution mode. And I think much of that focus will be talking with clients, talking with institutions around conversion of contracts where possible, and getting ready to operationalize that fallback trigger come end of this year. So lots of execution in terms of the program work still needs to be done.
Okay, that's great. Thank you. Let's see the poll results and see how people are getting on. Right. Very good. Jacob, would you like to comment on that? Nobody completely compliant yet. Does that look fairly as you would expect?
Looks like maybe we've got maybe rather few respondents there, but my expectation would be I don't think anyone should be complete yet. As Calvin said, there's still a lot of implementation work to do. Right. And if you aren't far progressed in terms of your planning, then you're going to find it pretty painful when you get to the end of this year.
Okay, well, let's talk about what needs to be done to get to the end of this year. And Mattia, can I come to you to talk about the key changes of the new regime and the outstanding challenges that must be addressed by the end of 2021, and how this can be done, and are there still clarity issues that need to be resolved? Mattia, you're
yeah, I was on mute. Sorry. Yeah,
that's okay.
Sorry for that. So I'll put the US dollar LIBOR slightly in a different space for now because there are different dynamics, I think. But if we look at the Swiss, Euro, Sterling, and Yen, I think both the RFR adoption and the conversion of a legacy will have to be tackled before the end of the year. Obviously, that's a given. They are all not at the same level. And they follow different trajectory, but they are in good shapes, all those markets, if you take them individually, as I think it's Jacob that was mentioning that earlier. So just as example, on Yen and the Sterling, there will be most likely a very strong or strong enough, let's say, term market. So it means that most likely we will have a synthetic LIBOR, which is a very good news for the transition. On Euro LIBOR, there is already this gigantic Euro LIBOR market that's available there. So if you're looking at those markets, they are in a good shape. If we're looking at dollar with the announcement of a June 2023 cessation date, I think the focus will simply or shift from to the development of the SOFR market, which is actually really needed today, and people will be able to tackle the legacy later. It's a good thing also because the legacy on dollar LIBOR is, let's say, the largest piece of the problem, and you will benefit from the return of experience we'll have on all the other LIBORs, the transition on all the other LIBORs. So that's a good thing. Now, regarding the challenges. There are several, but I will highlight 3 of them. The first space for me is the non-linear derivatives, where both from a new production where liquidity is very, very scarce today, and also from a development of let's say fallbacks for legacy trades, there is still a lot of things to be done. There are white papers that have been published on the transition for dollar and GBP CMS using the published RFR CMS, but it's still white paper, right? On yen, there's nothing yet. We know that ISDA is coming forward with some solution for the industry, but we still have 9 months to go. So it's for me, it's an area of concern. The other one is something I think put people short. Let me explain that. We were all expecting to have a SOFR term rates selected by mid-year this year, but with the recent ARC announcement, they said they will not, and most likely not before the end of the year. So I think for some businesses that were planning to rely on such solution, they have to find alternatives. It can be challenging. 9 months when you have been planning for 18 months, and now 9 months to go, I have to find a solution. The area where I see that area of concern, or at least we need to find an alternative, is Islamic finance, and also the trade export finance, where people were heavily relying on those kind of products. And of course, the last one, but I think everybody has that in mind, is there will be a lot of bilateral renegotiation before the end of the year, because the hard fallback, obvious fallback will not be everywhere, and that will be challenging. Regarding the last part of your question, and I will finish there, it's on the clarity. So for me, we know the end of Libor. It's very clear. We know exactly what will happen, and further delay should not be expected. Where certain uncertainty remains, from my point of view, it's around the synthetic Libor, and more especially, where they will apply, because that's not clear yet, and that's important to know. And also what's important to have in mind is that it will be known very late. So I don't think firms should rely heavily on those solutions. They should rather proactively move away from Libor on those transactions rather than let always fall back, and start bilateral negotiation where it's achievable, of course. Where it's not achievable, you have to find maybe wait for those solutions. And very similarly, the scope of application of those statutory solutions that we've been seen developing in the US and EU. So in EU, we've seen that they started to consult on a very small segment, which is a Swiss Libor for mortgages, consumer and small business loans. But for this statutory solutions to be really, let's say, interesting, we need to have a wider scope of application. So for me, this is where clarity still needs to be made.
Okay, lovely. Phil, can I bring you in on this question too? Changes, challenges, and clarity, basically.
Yeah, I mean, there's a lot of things in there, and just trying to unpick some of the buzzwords. So I think, the key changes. So I think the key change is that we've moved to a backward-looking rate, and so if you're an end user and you're having to sort of learn compounding and change your system and technology, and also have to grapple with the fact that you won't have that payment certainty. So 3 months, 6 months, etc. So that's where the 5-day lag comes in from a convention perspective. So you only know the final payment 5 days before. So I guess that's a big change. And if I think back to the term rate that was mentioned there and the experience we had in the UK market, the UK was lucky in the sense it was a reform SONIA, so the market's already liquid. And I think Jacob touched on that point at the beginning. About 2 years ago, there was a lot of noise in the industry around the need for a term rate. And I think we at the RFR group had to unpick need and want. So that then leads you to quite quickly to what an education process, understanding compounding. And I know that us as a bank spent a lot of time working with our end users to understand compounding, explain it. We came up with calculators that are on the websites to be used today. And I think that, coupled with a pretty stern line from the RFR group and the official sector around not creating a term rate market, coupled with the user group task force paper, which pretty much told the market over a year ago that you're not really going to get a term rate. You might if you're in a certain project structured finance, as mentioned, but everyone else, forget it. And certainly from my perspective, that was a really helpful message because it allowed us and the market participants to move on. I think the US is not been so clear. And so they've been promised it, but it won't be for a while. And so everyone else is just sitting on their hands waiting for it. So if it does come, it will be very late. Obviously, there's no liquidity in software to really build it at the moment. So I think, so there's a big change there. I think the messaging that all of us and institutions have to do is to help educate and make sure people understand these backward-looking rates. And as far as challenges, I guess that is a challenge. The book of work around managing the legacy portfolio is huge. And I think the way I would recommend looking at it is look at it through a risk-based lens. If you've got a cleared portfolio, the problem's going to be taken away from you. If you've got a clean bilateral linear market, then you've signed a protocol. That's also an option. But then if you've got non-linear, you're a dependency on the ICE swap rate methodologies, further documentation changes, or a loan-linked hedge where the protocol fallback have a 2-day and 5-day difference that could be a mismatch. So I think you really need to unpick your portfolios to understand what the challenges are. And then my final point is on the clarity of issues. I think in the UK market, and we only discussed yesterday at the RFR Comms Group, the path's pretty clear, right? The roadmap's pretty clear. The new products are there. I think it'd be odd for someone to say, I don't know what's going on. I mean, there's been so much great work by some of the trade associations that partner with us. So there's information out there. And as far as tough legacy or synthetic LIBOR, well, I don't think we should expect to get clarity on this. On one hand, if you get clarity ages ago on what's going to be deemed synthetic LIBOR or tough legacy scope, people will just sit on their hands. It's going to be a really small market. I'd be very surprised if there's a derivative market for synthetic LIBOR for obvious reasons. So it will be narrow. It will be for like legacy bonds pre-2017, sorry. So I think, yeah, it's going to be a small scope. So I'd almost forget about that for now. So yeah, lots going on. And again, it's very different depending on the UK, the US. In the US, they've got lots of other noise around different rates and will software liquidity build, but the clock is ticking and the end game is already set.
Okay, lovely. Staying with you, Phil, tell us a little bit about what happened at the end of Q1 2021 in terms of the milestones around the cessation of Libor loans and bonds and linked derivatives. Somebody mentioned those earlier as being a tricky problem. How difficult was it for the industry to sort of get past those milestones?
So these milestones in the UK market were, so last year was all about creating new products, making sure, so the bond market's been on SONIA for ages now, so it's not really an issue. The linear market was predominantly more and more SONIA, but they needed to turn the tap off. They had a convention switch, which was a SONIA first, really for the interbank market. So you've got the broker market to default to SONIA, not LIBOR. And again, all these things build liquidity. What we did need to do in the market is to turn off the taps for the linear market and will be the non-linear market later on, and the loan markets. Now, the loan market, this was well flagged. In fact, it was the only milestone that actually moved due to COVID. So the Q3 milestone became Q1, although Q3 then became having switch language in your contracts. So it's been very well publicized. It's also been followed up by quite direct letters, which are very public, the DSCO letters. And then, so I think, so it was difficult, the Q1 milestone for loans, but it was well publicized, and certainly banks like ours, and not alone, were engaging with their customers, ensuring that new products were understood. And yeah, no more LIBOR products. And as far as linear derivatives, a little bit different because there is an exemption for risk management of existing LIBOR positions. And so that then comes down to each bank engaging with their customers to understand, okay, you're coming in for a LIBOR trade. Have I told you that LIBOR is going? Have you convinced me that it's for a risk management positions, et cetera, et cetera? So that comes down to controls. And all of these things, turning off the tap will mean liquidity of LIBOR will drop off, and then everyone focuses on the active transition. Now, in the ARC, in the US, they've got some guidelines. I think the real proof in the pudding will become from the supervisory channels engaging with the big banks to stop doing LIBOR products or dollar LIBOR. And if they do it, it needs to have a pretty good explain. And the senior management regime or the equivalent thereof in the US will certainly drive activity as we're seeing in the UK market.
Thank you. Matteo, how did you see Q1 end? Was it a good ending?
Sorry again. Not a lot to add on that topic, to be honest, on top of Phil. what I can say that we prepared for it. When I say we, the market prepared for it pretty well, as it was highly publicized and known in advance, as the SONIA market also is extremely liquid and so on. It was quite easy. And as a firm, we were technically ready to trade, SONIA or alternative rate solutions. So I think we were in a good shape. Nevertheless, we can say that in few instances, we did see some firms, customers that were not completely ready for it, but they were in the process of being ready. Meaning by that, we had to accommodate for some temporary alternative solutions, let's say 2 months, 3 months before they can trade the SONIA. So in general, it was I think the market was genuinely ready on those. On insurances, we cannot really comment as Société Générale because we are not historically a big sterling floating rate FRN issuer. So we didn't see any trouble. So I think in the end, it was a very, very good exercise, a good rehearsal of what we will see for the other rates during the year. And as Phil mentioned, the most important milestone will be end of year for dollar. So from our point of view as a firm, it was an excellent exercise. I think it was a small scale enough so that it was well handled, but significant enough to be representative. So I think it was a very good exercise to start with GBP as this milestone.
Great. So lessons learned and good ones for the rest of the year, hopefully. So going back to you, Jacob, what alternative benchmarks and reference rates are firms using to replace LIBOR, and where are we with term rates and fallback rates?
So I think we've touched on quite a few of the alternatives already. I mean, I suspect most people on this webinar are already familiar. Each of the 5 working groups that were established recommended overnight risk-free rates as alternatives. And in theory, that should make life relatively straightforward. I think the challenge comes in the practice of then how you apply those overnight risk-free rates, and the key to the name. Overnight implies that there's not a term structure, and risk-free implies that it's not an interbank rate. So I mean, I tend to think of the world broken up into 2 parts makes it easier for me. We've got legacy positions. There's a lot of them, as we keep on hearing. LIBOR, the most important number in the world, the biggest notional outstanding of any benchmark being referenced. And here you have things like here's the fallback rates, and the work that's been done there makes it absolutely essential for what's going on to position the derivatives markets for the transition. More recently, we've seen the announcement from the ARC and the provision of the US dollar LIBOR cash fallback rates, which Refinitiv are very proud to be recommended by the ARC to be publishing those rates later on in the year. So very excited by that. But I think that's kind of the base case. How do you use the overnight risk-free rates in order to create something which is economic alignment or equivalent to LIBOR, the next best thing we can get to? And then the second question is, what do you do with all the new stuff that's being traded and issued, and how do you handle that? And then here, I guess the focus primarily is on then using the compound overnight risk-free rates without the credit spread adjustment. So whilst they've got lots of different names, there's a lot of commonality between the cash fallback rates, the ISDA fallback rates, the overnight rates. They're all different calculations and variants on the same theme and same principle. I think the only area where you don't see a difference is actually those markets where you need a term structure. So here we're talking, as Phil mentioned earlier, we've got things like trade finance, we've got Islamic finance, we've got some segments of the loan market. All of those groups of participants really need a term structure. And I think that is a relatively big difference we've got with the compounding, and it almost plays into kind of that comfort zone where people feel more familiar with what's going on. And here, there's already term rates, the GBP market. Refinitiv launched ours back in January. But I think the UK is in a very special position when it comes to LIBOR transition, going across the Atlantic and looking at the US. As we touched on earlier, there is no term structure yet. There's not a clear timeline for a term structure, and there's very valid reasons for that. But that's not a huge comfort if you were hoping that you'd be able to rely on that, and you don't have that comfort yet. So yeah, I think that's probably the best way of thinking about the breakdown of what's available and what's still to come.
Okay, thank you. Matteo, what would you like to say there?
Oh, what could I add to that? Yeah, of course, risk-free rates, main option to replace existing LIBOR and market company universe in general. As Jacob mentioned, there are some pockets where they are not applicable, and term rates or even fixed rates could replace those LIBOR and be seen as solutions. Concerning term rates, we already mentioned TORF on the Japanese market and TSR, Sonia's term Sonia reference rate are quite in good shape, and we see solution there. We do also monitor closely the developments in the dynamic credit spread market in the US, or the all-in rates, including those dynamic credit spreads, because I think this is quite peculiar, and there's really a need over there. But this is still for me under observation. They are not. There's no confirmation that those rates will be mature and so on. And regarding the fallback rates in itself for the legacy, as we mentioned earlier in the panel, all those fallback rates defined by the working group, be ARC or even the ISDA and so on, they are good solutions for majority of products, so they don't see any challenges there. There may be, as stated before, some issues with the non-linear derivatives, and so we really need to see some progress in this space to define the right fallback solutions applicable to those products.
Okay, thank you. I have a couple of audience questions. The first one, I don't begin to have an answer to, but Jacob may have the answer to this one. I don't know. How can we address inconsistency on fallback language? Does that ring bells with you?
It does. That's a tough one. I am going to say that I reckon Phil or Matthew can probably, well, actually Calvin, in fact, I reckon everyone on the school can probably provide a better answer than I can. So,
okay, Phil?
Yeah, I mean, it depends on what specifically inconsistency we're looking at. But for example, is to have a fallback 2-day and loan products have 5-day. So yes, there are mismatches. I guess the real question is, to what extent do you care? So you'll need to do your due diligence on that. The 2-day, 5-day, for example, we at the bank get lots of questions on that, but we usually say, well, actually, it's just a theoretical mismatch. I mean, sorry, it does mismatch, but to what extent does it mismatch and cause you concerns? And of course, without sounding too much like the regulator, if you don't like the fallbacks, then just actively transition. So fallbacks are the seatbelt, to quote Andrew Bailey, and just because you've got a seatbelt doesn't mean you drive with your eyes closed. So, be alive to what they are, be aware of how much they impact you, make your decisions accordingly, and you've got the active transition. So, superficially high level answer, but I guess the underlying tone is I still stand by.
Okay. Now, Jacob, I do know the answer to this one. It says, I have heard the term zombie LIBOR. What does that mean? What's it about?
So I think it's probably referring to the fact that we're going to end up with synthetic, or hopefully end up with synthetic LIBOR. So I mean, at the end of this year, we end up with the LIBOR cessation, and that's for most currencies and most tenants. And so at that point, outside the major currencies of US dollar, we'll end up with not seeing LIBOR as we know it today. I think the big challenge we've got is this huge mountain of legacy contracts. How do we handle it? And the solution to that one is a synthetic LIBOR. So, I mean, synthetic LIBOR economically should be very similar to LIBOR, but I think when you actually look at the construction of that rate, it's a different benchmark. It is ultimately a credit spread adjusted term rate, and I think there's an important use for it. But as Phil said earlier on, that use is going to be limited. It's going to be a subset of existing contracts, which there is no way of moving it across. And whilst it essentially acts a little bit like a safety valve, you need it, but you don't want to be using it.
Okay, fine. Zombie is not a word usually associated with financial services markets, is it? But here we have it. Anyway, let's move on, and let me come to you, Calvin, to look forward a little bit. What steps should firms be taking now to ensure compliance at year end? And is this an opportunity to simplify and rationalize change going forward?
Yeah, I think Phil touched on this earlier as well. There's a lot of good work that the Sterling RFR working group has done, as well as the ARC, providing that clear guidance on what that forward path looks like, right? And so that's why the Q1 cessation of Sterling Libor loans, derivatives, and bonds was a somewhat of a non-event, because leading up to it, there was a lot of clear direction on what that means, i.e. SONIA first. And then so when we look forward to the remainder of the year, it's making sure everyone's plugged into what the regulator guidances are, the industry working groups are saying. So when we come to the Q2 nonlinear derivatives or sterling, everyone's clear on what that means. And starting with May 11, I believe there's a, similar to the SONIA First initiative, there is a expectation for the dealers to start quoting nonlinear derivatives based on SONIA. So that's the natural kind of progression into the Q2 cessation. But everyone should be plugged into those working groups. Stay tuned on that, and consult with your compliance and your law team. They need to be part of it to understand what this truly means, the business as well, to make sure that everyone understands what that means, and then the training aspects within the program needs to be there internally. But then you also need to provide that training education to your clients and end users. In terms of your second question on opportunities to simplify this change going forward, I think a lot of it is making sure when you, like from a technology perspective, you're building in a way that is flexible enough to accommodate the change. So when term SOFR does come in, you have capabilities that are already in place. Maybe you just need to fine tune that. And then the same thing when you're building different system capabilities. You shouldn't just be building it for SONIA. You should be building it for SOFR as well, so that you can streamline that opportunity. And not just from a technology standpoint. I think if we look at it from an operations processing, it's the same thing. How you define it for SONIA is a good benchmark for how you should be structuring it for SOFR. So lots of opportunities on that streamlined process going forward.
Thank you.
That's just a quick update there.
Yeah. Jacob, what would you add there in terms of what people should be doing, so the steps they should be taking now, and whether that will help people rationalize some of the work they do?
I love Calvin's optimism. I'd love to share it. Maybe I'm a bit of a cynic. I think it's going to be tough for people to really rationalize and simplify their infrastructure. In a Libor world, you had one family of benchmarks, 35 different flavors of it. I think in post-Libor worlds, we have many more different variants, different conventions in different markets, different naming. And I think that's going to lead to just an added layer of complexity. So I would love for us to be in a scenario where we end up with a simpler, nicer, more objective framework that works better. I fear what we'll end up with is a tight timeline, a lot of tactical fixes, and a really complex set of different benchmarks used in different markets. So I really want to be proved wrong. I want to find out that we end up with great rationalization. I think it's going to be tough, but I think what it will do is I think we'll probably see two waves of this. We'll see a sprint to cessation dates, so end of this year and middle of 23. And I think we'll see a second wave of then review the work's been done and then try and work out how we can get onto the right infrastructure. And I think because of the complexities around Libor replacements that we've got, I think there'll be a lot of focus of, right, so we can't simplify the benchmark. What can we do to simplify infrastructure? What can we do to simplify data feeds? What can we do to simplify infrastructure? And it's a big theme within Refinitiv. How can firms use fewer data providers, simpler data models in order to try and compensate for them some of those problems?
Okay, thank you very much indeed. And again, looking a little into the future, and this is something we've touched on and off, Phil, coming to you. Will there be further changes to the timeline of the transition, do you think? And if not, do you think there'll be any regulatory leniency, or is it going to be straight in there?
Well, I think so. Well, your last question also talked about compliance. In some respect, this isn't like a MiFID 2, whereas, on this date, you've got to go live. And if you're not quite ready, you'll be ready in a week, then you can have a conversation with the regulator, perhaps. It's not like that. This is a market-led thing. So it's like LIBOR will end, full stop. So if you're not ready, you're not ready. So then it's like, okay, so if I'm not ready, well, for a start, you should have been trading Sonia in the sterling market since Q1, regardless. And if you're not ready to transition your legacy and you've got no fallbacks, then you're probably going to have quite a problem, because you'll have to get a last bank reference rate, which I don't even know what that look like. And then if you've gone to the middle ground, like, okay, I've not actually transitioned, I've got the fallback, then is that fallback optimal for you, depending if you've got non-linear, loan-linked hedges, etc. Then that's, again, that's the analysis I spoke of earlier. So it's not like a leniency, because it'll happen. How good that situation will look is dependent upon what path you chose to take, which is why getting these messages out now is so important. And same with the broader the bank's engagement, the communications group engagement. It's important that we lay out the facts. So, and as far as like, will there be any milestones or changes in some of the dates? I think the answer is no. I think that ship's already sailed, because of the ICE consultation and the results, and the FCA already saying it's not going to be representative by the certain date. It's, the only thing that could have flexed was if nobody was ready, then that date could have been moved. But I'm afraid that's set now, so it's a real thing. Yeah, and the only date has moved is the loans, and that was recognition of COVID, but it was only moved a little bit because you keep moving it out, you're going to create a greater problem down the line. So yeah, to answer you directly, it won't move, and there is no sort of leniency to give, because it's
just getting it done. Yeah. Okay. Jacob, would you see any changes in the timeline at all?
I agree with Phil. The only area of small amount of wiggle room comes to synthetic LIBOR. I think people's expectations are frankly probably already on the optimistic side. So I think it's only downside from there. But I would be very surprised. I think we're going to end up with synthetic LIBOR. It's been outlined that it's very likely to last for 1 year in Japan. I think the key question is in the UK market, are we talking like 5 years, are we talking 10 years? But really very little wiggle room. And to Phil's point earlier, if you're not prepared for this by the end of the year, it's going to be a pretty bumpy journey.
Okay.
And I would, sorry, Sarah, just to add to that,
Sure.
I would say that the dollar market being moved out to June 23, I guess, was a nod to the market not being ready. However, the no more dollar LIBOR by the end of this year, managed through the supervisory channels, again, is a pretty direct tone. And Ionia is going at the end of this year, and I think what will probably happen is once dollar's gone, sterling's gone, all the other markets are gone, I think the big question will be not if, but when is your IBOR going to go? And that we've started to hear a lot more conversation around that in the market.
Okay, thank you very much indeed. And to our audience, if you have any more questions, please do send them in. We still have time to take a couple more probably. But as you're thinking about that and putting your questions in, also can you be thinking about our next poll? The question this time is, what is the additional cost and skills requirement at your organization to achieve the transition? I think people have very different views on this, but share some of your thoughts on that on the poll if you would. And while you're doing that, let me ask Calvin how he sees the additional cost and resource burden of the transition and how financial institutions are managing this.
Yeah, it's a massive undertaking, right? It's not a side of the desk program. So I think in the beginning of the program, a lot of the costs have been around technology spend and getting those RFR-based products up and running. What we're now starting to see is that shift into contract remediation spend. So the cost profile has changed to now from technology more to the legal documentations and the operations side of things as we move towards that active conversion of the back book. It's important that the firms dedicate resources to work on this transition. Again, it's not a side of the desk initiative, so carving out resources to focus on operations and not a BAU activities is crucial to the remaining of the program.
Okay. Phil, what's your experience here?
Yeah, well, I suppose, as a main UK bank, we've been kind of having a program project for years already. And even before that, it was very business led. I mean, people have been trading Sonia for years. It's commercially, it's in your best interest to be on the front foot of this. I think for sort of the corporate market, it was more of a, oh, wow, okay, this is going to change. So I think that's where the efforts have had to focus recently. So I think it's a big beast. It's a big project. It's been running a while in the UK market. My experience is that making this business led is the best way, because if you run it too much in an operations or a legal, that's where sometimes it stays, where really it's about engaging your clients, knowing what products they've got, driving market liquidity, creating new products. And there's a lot of operation front to back and legal work to be done, but you really need to be trading these new products. Well, Sonia isn't new, but software, for example. And I think the business will have a greater power to influence the rest of the program. It's not a siloed project. So having a really dynamic front to back workforce is important, and lots of communication internally. If there's credit sensitive rates in the US, are they going to take off? Yes, no. Are we going to have a term rate? Yes, no. We need to message it. Are we being education clients on understanding compounding? So it's you've got to have it front office, business led.
Yeah, maybe I can change. Yeah, sorry, Phil. I think I agree with you. Business heavy, unlike other regulatory programs where it's another program forced down on the business and forced down on the organization. This one has a significant impact on the business, and so they've been very engaged throughout this past 2 years, because it ultimately changes their profile of what they are transacting in. So absolutely, their engagement is key.
Okay, thank you. Let's see the poll results, if we may. Thank you very much indeed. Calvin, would you like to comment on that? I thought everybody would say significant, but some costs, but perhaps that's what Phil was describing. Calvin, what would you say about the poll?
Yeah, I think I'm maybe surprised a little bit that it's some cost and not significant cost. But I guess depends how organizations are capturing those cost profiles onto their program and charging it back. So yeah, I'm okay with this poll results. It seems to make sense.
Okay,
it's good
great.
that it's no cost. I'm glad to see that it's zero on no cost.
They've done a magnificent job, haven't they? Those ones, but there aren't any. Does it like you'd expect, Phil?
Yeah, I think Cal's point is valid. So like we've got a lot of people in our business, bond market, loan market, swaps market, who are engaging clients on market developments. I mean, that's their job, of which LIBOR is a huge one. And so whether that project, those people charge their time back is a question, I guess. And yeah, I mean, it's a big project. It depends who you're asking, I guess. If from a big bank's perspective, who are meant to be kind of leading and driving this, then it's going to be huge costs, huge new product lending and legal costs. So yeah, it depends how you charge it back. It's not like, I say, like a MiFID 2 or a mere margin where there wasn't margin, there is margin. This is like a quite dynamic. So it depends how you book the cost, but yeah, greater than zero, that's for sure.
Okay, yes, absolutely. Staying with you, Phil, what types of technologies, tools and solutions and services can help firms as they make the transition?
I'll have a go at this one. So I think I go back to so technology tools. So something we did in NatWest was we took an Excel calculator and we put it on a web portal, and that's really where we point our clients to understand compounding, different dates, different conventions, and that's really been for us absolutely key and core, and still will be. I think at the beginning, a lot of law firms came to us saying, "Oh, we can magic away, or you're legal with AI," and I'm a very skeptical person on things like this. So if it sounds too good to be true, it usually isn't. So I think, look, solution services, I think educational tools is one. I think getting organized internally, and just that I don't really see any brand new kit here be able to magic away my problems. But maybe others have got a view.
Okay. Calvin, have you seen anything magic Can I help here?
No, I laugh because Phil, when he mentioned the AI tools on documents and contract remediation, I agree that was probably the early days. Now it's more, let's get on with it. So if you don't have a operational workflow around CRM tools and documenting client conversations, maybe you should explore that. But it's a bit late in the game to be exploring those new technology solutions now. It's really just drive forward with execution at this point.
One thing I would add is you'll see markets and businesses develop to find efficiencies, and that's, you know, so Jacob's point earlier is there's going to be more products out there. There's more basis trades in certain markets. I think markets will evolve and adapt. I think one example is I think ICE have come out with these indexes recently to create standardization for the SONIA market. I'd imagine they're looking at other markets. I think that's, you know, a number that the industry can coalesce around and efficiently move forward. I think that's good. I think, you know, talk about realiserate.com, also calculated this again. So I think people will just see, well, where are people struggling in the sort of BAU world, and where can I find an edge to create standardization? But I think it's too complicated to have like one magic, oh, let me come in and take all of your legal problems away. I think that's just too optimistic.
Okay. Jacob, do you want to comment on that on the solutions side at all?
I mean, the big theme that we see in Refinitiv is standardization of data. You know, with so many different data points to feed into, if you can have a standardized data model, if you have one ingest system, it's a huge benefit. So that's, you know, where we put a huge amount of investment and focus, trying to alleviate some of that burden.
Okay, thank you. That's useful. Okay, let's take our last audience poll now. And this one looks at the benefits of this huge challenge. And it really is, as everybody says, a huge generational challenge. And it's about what extent of operational and business benefits you can gain from the transition beyond getting it right. So if you'd like to place your votes now, and while you do that, Mattia, can I come to you to talk about the operational and business benefits that firms can expect to gain from a successful transition?
Yeah, of course. And this time I didn't forget to unmute my microphone.
Thank you. And speak up a little. You're a little bit quiet. Yeah.
Oh, yeah.
Thanks.
Is it better? Yeah.
Yep.
So for a successful transition, what is it? Really, it's our capacity, our ability to bring over our customers to alternate solutions, you know, in a seamless manner. So clearly, if we do a successful transition, it means that we'll have provided client satisfaction and continuous support to our clients. So there will be immediate business benefits. It's always a plus in a commercial relationship when you're able to help your clients. It's not a guarantee, of course, but it's always a plus. On the contrary, if we are late, it's a certain threat to our capacity to serve our clients. So direct impact on our commercial franchise, if I may say. That's on business benefits. So for me, it's pretty clear cut. On the operational side, I'm much more nuanced. Of course, we have seen some benefits where we correct, because when you're talking Libor, you have to look to do a deep dive in all your processes, because Libor is embedded everywhere in the bank. And of course, we discovered some processes where the user's Libor was under efficient, or even sometimes not quite, let's say, correct. But really, that's a side effect. I would rather say that with the multiplication of conventions that we discussed before, because we are still testing which convention should be used for which markets and so on. So we have to develop a lot of different conventions. And when you say conventions, it means also that you have to adapt your asset liability management to cope with all those, you know, last reset, last recent, backward looking, look back 5 days and so on conventions. And also we are creating, we are coming to what I would call a multi-rate environment in certain markets, where it was pretty easy before. It was only one rate. Here you have to pick and choose. That we cannot do as a dealer. So we have to develop and try to be ready on all those markets. So for me, it's a big overhead, where we don't see any operational gains, at least now, maybe in a few years, but currently it's very difficult to see any gains, at least operationally, from that. That's
Okay,
point of view.
thank you. Jacob, what would you say in terms of business and operational gains?
I think the big gain is just we've seen what happened with Libor. We saw the manipulation scandals, we saw the fines that followed. I think all of it creates doubt in people's mind over the integrity, efficiency of the capital markets that we have. And I think the risk that gets undermined is a terrible cost on everyone. So I think the big benefit to financial services firms, society at whole, is the fact that we now have more trustworthy rates being introduced, and they tend to move more in line with that of the central bank's actions. If we go back to whatever it was, February, March last year, the COVID crisis hit. We saw interest rates in the base rates across the world cut to near zero. Mm-hmm. What happened to Libor? Well, it kind of hovered not that far off where it was before. Your risk-free rate plummeted and your credit spreads widened massively. And it took, several months for the credit element to then die down and the rates to follow. So I think in an environment where actions of the central bank feed through into the real economy, just like that, it's another benefit for everyone who's involved.
Okay, thank you. Different way of looking at it. Thank you very much. Let's look at those poll results, if we may. Okay, well, the difference in opinions here slightly. Jacob, would you like to comment on that? Obviously, it's not what you were talking about, but good to see some people think they're going to be operational benefits and some business benefits, but not as much. Does that seem sensible to you?
Yeah, I think that's fair. I think there's lots of different ways of looking at this. You saw the difference between how Matthew looked at and I looked at it. It really depends the lens. There's a bigger picture of which I think society benefits. And there's some of the more operational elements, which I think it's tough to get the benefits out of. So it seems like a pretty fair outcome to me.
Okay, thank you very much. And Kelvin, I have an audience question, which I think you'll be able to handle. And it asks, how best can small asset managers and wealth managers manage the huge task of transition? I think this has been quite a concern among smaller firms. How can they get to grips with all of this?
I think there's a lot of ways. So one is talking to your financial institutions. Reach out to RBC, reach out to NatWest, SocGen. Anyone on this panel can certainly help. I think it's starting that dialogue as a first step, and so that firms have a basic understanding of the transition. And if you pass that point of Libor 101, then let's move on to a discussion around the transition itself. And then as a homework, I would recommend that firms definitely complete their assessments and scoping exercise, right? Making sure you understand all of the Libor impacts you have. How are the contracts, what are the contracts language associated to those transactions that you have? Because that scoping exercise is important, and then you can figure out from a risk-based profile or approach, figure out how you want to tackle each component of it. And again, starting with the non-dollar Libor components first, if need be, and then switching over to dollar transition later on. But I think definitely it's the talk to your FIs, and then secondly, make sure you have your scoping sizing done.
Okay, thank you very much indeed. So finally, and pulling together everything we've talked about during the webinar, let me ask our experts to sum up their advice for firms working on the transition. And Jacob, would you like to start here, please? Yeah,
so 3 pieces of advice. I'm unsurprisingly going to take a data lens to all of this. It's very close to my heart. Piece of advice number 1, go through your current systems, identify where you've got Libor exposure, and document it as soon as you can. Number 2, work with your suppliers, your data vendors, as quickly as possible Make sure you know what you need in terms of replacement, think about licensing, think about contracting, think about how you're going to get access to the data. Come back to the point we were making earlier around what opportunities are there to try and rationalize infrastructure. I think the quicker you do that, the less you'll be forced down to making tactical decisions and the more pleased you'll be with the outcome. And then that kind of takes us on to 3. Where are the opportunities for rationalization and consolidation? Is there a way that you can take away 3 data inputs and replace it with 1? How do you make sure you normalize your data models and make it as easy as possible? So those are my thoughts. I'm sure the rest of the guys have some really good kind of customer-centric thoughts as well, though.
Well, there are 4 of you today, so I think there may be a bit of an overlap. Calvin, what advice would you offer?
Yeah, very similar to Jacob. I think time is running out, right? And we need to move forward to ensure smooth transition. So as Jacob mentioned, make sure you understand your scope, make sure you understand that step 1. Secondly, have the conversation with your buy side, sell side institutions, because it takes 2 to convert your back book, and so that needs to happen. And then lastly, I would say that we should make sure that just like any other project or a program, you need to make sure you test and repeat and test and repeat, right? To make sure that your systems are ready, your operational process is ready, and that is a huge component to a smooth transition as well.
Thank you. Matthew, what would you advise people to do who are on their way?
So very similarly to I think Calvin. I think everything is set. Okay. We should expect very, very little from the clarification that could be brought on the scope of use of the synthetic Libor or statutory solution. So don't wait, start now. And as mentioned, document where Libor sits in your systems, institution, and so on, and fix it. Along those lines, proactive transition is a must. As we said, the fallbacks are seat belts. You don't want to use them in all instances. So it's very important that both sell side and also buy side start to discuss those bilateral trades that you need to transition. That was safe. And also, and that's the third advice, and we didn't touch upon. I think it's very important not to underestimate the effort that will be required to migrate those hardwire/robust fallbacks, because operationally it can be challenging, even though legally it's quite clear because you know exactly what would be the fallback rate. Operationally it can be quite challenging. We've seen that as institutions with huge position in CCPs, when they change the discounting curve, it has implication both on your external trade but also your internal trade. So do not underestimate those easy transitions. I would say seems easy, but operationally can be challenging.
Okay, and Phil, some final words from you, please.
Yeah, so firstly, I would follow the Sterling RFR working group on the LinkedIn page. It's there to give you real-time information. Secondly, know your clients, understand the sophistication, understand the way they trade, understand the jurisdictions they trade. And then thirdly and finally, understand, have a risk-based lens on top of that. So if you've got a cleared portfolio, the path is set. If you've got a bilateral and you've got a protocol, you've got a fallback in place. But if everything else is a little bit more complicated, and therefore spend the time on that. So risk-based lens on your clients and your jurisdictions.
Okay, thank you. Thank you all very much indeed. And thank you for sharing your expertise and experience with us today. Clearly, there's still a lot of to do, but there are plans in place. Thank you too to Refinitiv for sponsoring today's webinar. Before we close up, just a quick reminder that you can register for our RegTech Summit Virtual in June using the additional options section at the bottom of your screen. You can also download the latest version of our regulatory data handbook or download a white paper on how to leverage the Libor transition to improve your data management. That said, that's it for today. So thank you again to Jacob, Mathieu, Calvin, and Phil, and thank you to all of you who have watched the webinar. Please complete our feedback form, as we're always keen to hear your views and improve our products. Meantime, thanks again and goodbye.